Hello, seniors. June 15th is just around the corner. And if you are retired and collecting income from Social Security, a pension, an IRA, a 401k, or any combination of those, there is a real chance you owe the IRS a payment by that date that nobody reminded you about. Not your bank, not your broker, not Social Security. The IRS does not send a personal reminder when a quarterly estimated tax deadline is approaching. They just add a penalty when you miss it. This video exists because the June 15th deadline catches more retirees off guard than almost any other tax obligation in the calendar year. And the reason it catches them is straightforward. Most people spent their working years having taxes withheld automatically from a paycheck. Retirement income does not always work that way. And the gap between how taxes worked before retirement and how they work after it is exactly where the penalties live. Let me explain what this deadline actually is before anything else. The IRS requires taxpayers who expect to owe at least $1,000 in federal taxes for the year after subtracting withholding and credits to make quarterly estimated tax payments throughout the year. There are 4 of these payments. The first was due April 15th. The second is due June 15th. The third falls on September 15th. The fourth lands on January 15th of the following year. Each payment covers a specific portion of your annual tax liability, and together they are how the IRS collects taxes from people whose income does not have automatic withholding taken out of it. If your retirement income flows to you without sufficient tax being withheld at the source, and for a large number of retirees it does, estimated quarterly payments are not optional. They are required. Subscribe to this channel and turn on notifications before we go further. Tax deadlines like this one do not get announced in the news the way April 15th does. They arrive, they pass, and the penalties accumulate quietly. What I do here is put this kind of information in front of you while there is still time to act on it. Hit subscribe and let's keep going. Here is the part that surprises most retirees the first time they hear it. Your Social Security benefit may be taxable. Up to 85% of your Social Security income can be subject to federal income tax, depending on what the IRS calls your combined income, which is your adjusted gross income plus any non-taxable interest plus half of your Social Security benefits. If that combined figure exceeds $34,000 for a single filer or $44,000 for a married couple filing jointly, 85% of your Social Security benefit is included in your taxable income for the year. That is not a penalty. That is just how the tax code treats Social Security above those thresholds. And because Social Security does not automatically withhold federal taxes unless you specifically request it using Form W-4V, a significant number of retirees go the entire year without a dollar of tax being withheld from their Social Security payments and then face an unexpected tax bill in April. The estimated payment system is how you avoid that bill turning into both a tax liability and an underpayment penalty on top of it. Pension income operates similarly. Most private pensions and government pensions are fully taxable as ordinary income at the federal level. Your pension administrator should be withholding federal taxes from your monthly payment unless you directed them otherwise when you retired. Pull out your most recent pension stub and look at the federal withholding line. If it shows 0 or a very small amount relative to your monthly payment, your withholding may be insufficient to cover your actual tax liability for the year. The same check applies to distributions from traditional IRAs and 401k accounts. Every dollar you withdraw from a traditional retirement account was tax-deferred when it went in, which means it is fully taxable when it comes out. Brokerages and plan administrators may withhold a default rate of 10% on IRA distributions. Whether 10% is enough depends entirely on your total income picture for the year And for many retirees drawing from multiple income sources simultaneously, 10% is nowhere near the actual effective tax rate they are facing. Required minimum distributions deserve specific attention here because they are the source of the most frequent unexpected tax bills among retirees over 73. The IRS requires you to withdraw a minimum amount from traditional retirement accounts each year beginning at age 73. That minimum is calculated based on your account balance at the end of the prior year, divided by a life expectancy factor from IRS tables. The distributions can be substantial, particularly for people who have been accumulating in tax-deferred accounts for decades. A retiree with $600,000 in a traditional IRA at age 75 faces an RMD of roughly $25,000 for the year. Add that to Social Security, a pension, and any investment income, and the total taxable income figure climbs quickly into territory that generates a meaningful federal tax liability. If withholding has not been adjusted to account for the RMD, the shortfall shows up as both a tax bill and a potential underpayment penalty. The underpayment penalty itself is worth understanding in concrete terms. The IRS calculates it based on the amount you underpaid multiplied by the current interest rate for underpayments, which changes quarterly and has been running at elevated levels in recent years. For 2026, it sits at 8% annualized. That penalty accrues from the due date of each missed quarterly payment, not just from April 15th. Missing the June 15th payment means the penalty on that quarter's shortfall begins accruing in June. Missing September 15th adds another quarter of accrual. By the time April rolls around and you file your return, the accumulated penalty on 4 quarters of underpayment can add hundreds of dollars to what you owe, entirely separate from the underlying tax itself. The good news is that the IRS provides what is called a safe harbor rule that protects you from underpayment penalties even if your withholding and estimated payments do not cover your full current year liability. If your total tax payments for the year equal at least 100% of your prior year's tax liability, the underpayment penalty does not apply. Pull out your 2025 federal return and look at the total tax line. If your combined withholding and estimated payments for 2026 are on track to match or exceed that number, you are protected under the safe harbor regardless of what your 2026 tax bill ultimately comes to. There is a modified version of this rule as well. If your adjusted gross income in the prior year exceeded $150,000, the safe harbor threshold rises to 110% of the prior year's liability instead of 100%. Either way, knowing your prior year's tax number gives you a clear target to work toward for your 4 quarterly payments, and it removes the uncertainty of trying to calculate your exact current year liability in real time. For retirees who want to simplify the entire estimated payment process rather than tracking quarterly deadlines throughout the year, there is a straightforward alternative. You can increase federal tax withholding directly from your income sources. If you receive Social Security, file Form W-4V with the SSA to elect voluntary withholding at 7%, 10%, 12%, or 22% of your monthly benefit. If you receive a pension, contact your pension administrator and update your withholding election to a higher amount using Form W-4P. If you take regular IRA distributions, instruct your brokerage to withhold a higher percentage. Concentrating your withholding in the 4th quarter through a larger IRA distribution with maximum withholding is also a legitimate strategy because the IRS treats withheld taxes as paid evenly throughout the year regardless of when they were actually withheld, which can retroactively satisfy earlier quarterly obligations. That flexibility does not exist for estimated payments, which must be made on schedule to avoid per-quarter penalties. Let's talk about investment income because it catches retirees with taxable brokerage accounts in a specific way that is worth naming directly. Dividends, interest income, and capital gains distributions from funds held in taxable accounts are all potentially taxable and typically have little or no automatic withholding applied to them. If your brokerage account has been generating income, or if you sold investments at a gain earlier this year, that income is part of your 2026 tax liability, and it is almost certainly arriving without withholding. If you have not factored it into your estimated payment calculations, the June 15th payment is the moment to adjust. Log into your brokerage account, pull your year-to-date income and gains summary, and incorporate those figures into what you send the IRS by June 15th. The practical path forward from here is not complicated, but it does require you to act this week. Pull your 2025 federal tax return and find your total tax liability for that year. That is your safe harbor target for 2026. Subtract whatever federal taxes have already been withheld from your income sources year to date and whatever estimated payments you have already made. The remaining amount, divided across the 3 remaining quarterly deadlines with the second due June 15th, gives you a working payment schedule. If your income has increased meaningfully since last year because of a larger RMD, a new pension payment, or additional investment distributions, the prior year safe harbor protects you from penalties, but you should still plan for a higher April balance due, knowing that in June is worth far more than discovering it in April. You can make your estimated tax payment at irs.gov through the direct pay system, which is free, does not require an account, and processes payments in minutes. Select the estimated tax payment option, choose the June 15th due date, and the payment posts immediately. Keep the confirmation number. The IRS system works, and the process is straightforward once you have done it the first time. June 15th is a deadline that does not announce itself and does not come with a warning notice. It simply arrives, and then it passes, and if nothing was sent, the penalty clock starts running. You now know it is coming. You know why it matters for retirement income specifically. You know what the safe harbor rule is and how to use it, and you know exactly how to make the payment. The only remaining step is to do it before the date on the calendar changes. Subscribe, share this with a retiree you know who might not be aware this deadline exists, and I will see you in the next one.